Welcome, everyone. I'm David Darst. Want to visit with you, give you a little recap of the third quarter 2021. The Standard & Poor's 500, as we close out this quarter, is up 16%. September is turning out to be somewhat of a contraction, not a 5% correction, maybe around 4% for the month. The Russell 2000, which is your small and mid cap, and is often indicative of how the economy is likely to be going later this year and into next year, is up about 12.7% year to date. The bank stocks, as interest rates have started to climb, the bank stocks have really performed well. They're up 36% thus far this year. And finally, the transportation stocks. That's the airlines, that's the railroads, that's the trucking stocks, that's United Parcel Service, that's Federal Express. They have had higher fuel prices. They've had labor shortages. They've had the inability to pass on all of their costs. They are raising prices. And that index, which is indicative of how well people and freight are moving through the economy, is up only 13.9%. It is still positive, but it's not nearly as advanced as it had been. Now, the 10-year Treasury interest rate. This is a key indicator. Many loans are priced off of the 10-year Treasury. Many other securities are priced off of the 10-year Treasury. As you know, it began this year at 0.93%. It has risen in recent weeks. It's now about 1.55%. And the 30-year Treasury, which started this year at 1.65%, is now 2.09%. So you've seen gradually rising interest rates, which is one thing that we have been saying. You could expect rates to rise slowly as this year progresses. The key is not the amount that it gets to, but the pace. If it starts to rise too quickly, that gets investors nervous. That tends to hit the bond pricing. It tends to hit some of the very high-priced technology stocks. The volatility index, which is another indicator of complacency, the long-term average is around 15 or 16. It's now 22, which is actually good. It means to us that people are reassessing and taking stock of things, which we're going to do with you right now. The oil price started this year in the United States, the West Texas Intermediate, at around 45. It's around 75 now, with Brent $3 to $5 higher than that. Brent actually touched $80 this week, as you know. Now, let's take a moment and talk about the Biden agenda and where all of that stands. Now, President Biden has had a few political maybe you could call them setbacks, but you could call them challenges, okay? Afghanistan, the exit from Afghanistan. Secondly, the inflation numbers, okay? They have been rising. So people have been, the mainstream people in the United States have had some challenges on the inflation front. Then the southern border. There's been some issues over whether, and some discussion over whether it's adequately closed. You've had a lot of migration from Central America, from South America, from Caribbean, okay? But now the key thing here is the state of flux of the negotiations over the infrastructure, not only the hard asset infrastructure, but the social infrastructure. This has been back and forth. Nancy Pelosi, the Speaker of the House of Representatives, the Republicans, the Democrats. So this, as we speak, this is in a great amount of flux right now. And of course, how are you going to pay for these programs if they get passed? That's when the taxes come into the equation. You're talking about capital gains taxes. You're talking about increase in corporate taxes. You're talking about increase in personal income taxes. So all of these things are associated with one another. It's our best guess right now that it's going to be a lot less serious and negative than the markets had been anticipating earlier. Let's move on and talk about earnings right now. The Standard & Poor's 500 earnings. You remember, the first quarter was up 48% year over year. The second quarter, tremendous performance, 89, 90% earnings gain for the second quarter. The third quarter, we expect the third quarter will be a significant slowdown from the 89, 90% of the second quarter. What are we looking for? About 28%, and that's year over year. And the fourth quarter is expected to be 21% year over year. Now, when we go into the first quarter of 2022, right now, the analysts, this is FactSet, this is Refinitiv, this is Bloomberg, where they compile the analyst forecast. They're looking for the gain year over year, first quarter 2022 versus first quarter 2021, to be only plus 6%. So you look here, you're talking about a 43% composite earnings gain. That's our best thought right now for 2021, 43% year over year. And next year, 2022, as of now, 10% year over year. Let's spend a moment now and talk about the economy. The economic momentum is definitely slowing. One of the National Bureau of Economic Research compilations, they're taking 43 leading economists and they're compiling their thought for the GDP, real growth in the United States, plus 6.7%. They've reduced that now to plus 5.6%. That's just in the last few weeks. Now, they have transferred some of that slowdown into a better number for next year. For 2022, they basically were looking at 2.8% growth. And look, these things can change. They can fluctuate. Right now, they're looking at 3.5% growth. I just think we would be remiss if we talked about economic growth but did not talk about inflation. Now, the Federal Reserve, they have tons and tons of economists. They've been too low on their economic forecasts of inflation. Back in December, the median forecast of the 12 Federal Reserve governors, the median forecast was supposed to be inflation this year of 1.8%. By March, it was 2.4%. Listen, in June, 3.4%. And in September, just this month, they've raised it to 4.2%. Why? Supply shortages. You know the reasons. Supply shortages, labor. They've had to pay up to get labor to come back to work. So this has been some of the key drivers of these inflation. Now, Chairman Powell has been saying that inflation is going to be transitory, but just this week, he said it's going to last longer. It will be transitory, but it will last longer. You have some very, very thoughtful, smart economists, investment strategists, or they don't necessarily agree with him. But right now, the market seems to agree that inflation is going to stay higher for longer and then begin to turn down. That turns us to another topic, which is recession risk. So the economy's been slowing. What is the recession risk right now? We consider the recession risk to be relatively low right now. Why? The consumer's balance sheet is in pretty good shape, okay? House prices have been up almost 19.9% year over year, according to the Case-Shiller Housing Price Index that was released just a couple of days ago. The consumers got a lot of liquidity, a lot of cash. Now, in their securities accounts, they have record levels of equity exposure, 65% according to Bank of America Merrill Lynch. And cash is a record low as a percentage of their securities. But outside of the securities accounts, bank deposits, money market funds, okay, there's $2 to $3 trillion. Okay, so recession risk, in our opinion, is low right now. If this should change, we will certainly alert you in calls like this. You have the business sector. They're in pretty good shape. They've got a lot of cash. They've raised at these low interest rates. There's a great amount of corporate liquidity there. You have government. That's the key. Are they going to raise taxes? But right now, we deem the recession risk to be quite low. Now, Let's talk about the vaccinations progress. Right now, according to the Center for Disease Prevention and Control and Johns Hopkins University, a total of 392 million doses have been delivered in the United States as of late September, as of a couple of days ago. 184 million out of the 330 million Americans have been fully vaccinated. So that you're talking about 56% have been fully vaccinated. And look, that includes children. They're beginning to vaccinate younger children as they go back to school now here in September. And our thought is maybe 15 to 20% of the people have had COVID, okay? And we would be remiss if we let this moment pass without expressing our tremendous sympathy and condolences to the families of the 675,000 people in America who have lost their lives in the COVID pandemic. Now, let's wrap up here and talk about risks. What are the risks? And we always want to emphasize, what do we need to be thinking about so we do not get surprised or blindsided by risks? First of all would be, if inflation really continues to rise further and looks like it's going to be built into investors and consumers and businesses' behavior and their psychology. So if that would put pressure on the big high-flying technology stocks, more on that in a moment. Next one, there's the Delta variant. It seems to be going down now. That's a positive, okay? If you got new Lambda, Iota, Kappa, okay, Mu, Nu, if you got new variants of this that were substantially more communicable, okay, and more serious, that would be a risk. Right now, we don't see that. We don't see that. Taxes, if taxes go up, that would be if they go up significantly. The market's built in some taxation, as I mentioned a moment ago. But if they go up significantly, this is a risk, okay? Lastly, you have concentration. 22.5% of the valuation of the Standard & Poor's 500 is basically concentrated in 5 companies. Is that a good idea? Yes, they're powerful. Yes, they're profitable. I'm talking about Apple. I'm talking about Amazon. I'm talking about Microsoft. I'm talking about Google Alphabet. And I'm talking about Facebook. Don't forget, these companies are very powerful. They're very cash rich. They have tremendous business franchises. But that would be a risk if interest rates start to rise, because high interest rates will affect the discounting factor of these big corporate enterprises that are very highly valued. So concentration, and this brings us to the valuation, the last big risk in our opinion, and it's never the trigger for a bear market to begin, but it is something that's a warning light. And right now, the Standard & Poor's 500 index is trading at 21 times next year's earnings. The long-term average is 13 to 15 times next year's earnings. The other one is the Case-Shiller cyclically adjusted price-earnings ratio, CAPE, cyclically adjusted price-earnings ratio. That takes price divided by 10-year average earnings. Again, it is not a trigger for a bear market. It is not a trigger for a bear market, but it is about 37 now. The highest it's ever been is 44, only once, back in the dot-com era. And the lowest it's ever been is 4, back in 1919, after World War I. So what we're saying here is we have high valuations, high concentration. Some of the speculative excess has come out of the market. We, believe it or not, a correction would not be a bad thing. It would clean things out. It would clean out excess. It would clean out excessive euphoria, excessive optimism. Over-optimism has been reduced somewhat here in the month of September, which is a classic September. September is the worst month of the year, down about a little bit over 1% on average over the last 80 years. September tends to be the worst month, and it's turning out to be a tough month this year, the worst month this year since January. We think it's usually a stock market year has 3 corrections of 5%. It's been 227 trading days, almost a full year of trading days since we have had a 5% correction. This is a 4% correction. We've not yet had a 5% correction. We've had 4% corrections, but no 5% corrections and no 10% corrections, which you usually get at least one per year. We want to thank you for listening today, and we want to wish you a very, very great start to the fourth quarter of 2021.